This is InvestTalk, independent thinking, shared success.
I had a question about ticker symbol WMS, Advanced Drainage Systems. We spec out this product a lot where I work, and just kind of wanted to know what your thoughts on the company were, what would be a good entry point for them, and just the sector that it's in, kind of what that sector looks like moving forward. Appreciate what you guys do.
All right, looking at WMS, this is Advanced Drainage Systems, and they manufacture water management solutions in the storm water and on-site septic wastewater industries. Okay, so this is a $9.4 billion market cap company. So kind of in the mid-cap space. Earnings this year supposed to be down 4% to, let's see, $5.62. Next year, back up 12% to $6.29. That would still be down from 2024's peak, which would be $6.38. Okay, so certainly a slow growth name, but it's trading at a multiple that is closer to the market, about 20 times forward-looking earnings. I don't love to see that. I don't love to see a slow growth business trading at market multiples. Usually doesn't seem right. Now, the balance sheet is good, only about $500 million in debt on a $9.2 billion market cap. Debt to equity ratio is only 0.78. Not too bad. No real issue there. Free cash flow, $368 million. Solid, but it is coming down from a previous high of about $571 million. So it's about where it was. It's still above where it was pre-COVID. It's where it's at kind of in the 2020, end of 2020. That's where free cash flow is sitting. Return on equity is 30%, which I like that. I love that profitability. 30% return on equity is solid. They were buying back shares. They've slowed down that, which is fine. Pay down a little debt. No big problem on that side. But if you look at, like I said, return on equity 30%, it's come down from its high around 45, but still, even pre-COVID, its return on equity, it was around 20% peaked out, and now it's at 30. So, is it over-earning a little bit potentially? Overall, I kind of like it. I just like businesses that have good balance sheets, that have good profitability, that have good consistent cash flow, etc. Now, the earnings trends are not amazing, but the chart has been improving lately, and it's trading at a little bit higher valuation than I would like. Let me pull this up. Enterprise value to EBITDA, currently at about 11 times. Historically, 5-year average is 14, so it's trading below that. And therefore, I'm going to give this one a thumbs up. It's trading at the low end of its enterprise value EBITDA range, which to me is a better multiple than PE. And I like clean balance sheets. I like good businesses. And so I clearly use it regularly and probably like the products. And that shows in the quality of the business. Now, every day we receive questions from the comment section of the InvestTalk YouTube channel. And here's one that came in earlier. Roy says, what do you guys think? Wondering if you guys have a good play for agricultural commodities would be citrus grower LMNR. LMNR. Now, what he's talking about is we have a quarterly market analysis report that if you want a copy of it, let me know. Send us an email. And it's overweight, underweight certain sectors, certain asset classes, etc. And right now, like most commodities, overweight ag, but you have to be very selective. And for this one, this is out of here in California. They produce lemons, avocados, oranges across California. Now, the issue is that with like most commodity producers, there's not really an economic advantage. They typically are what we call price takers. So they take what they can get for their products, especially products that spoil. Oil, gas, you can kind of store them and wait for a better time to sell them. Can't do that with lemons and avocados and oranges for the most part, right? You can pick kind of a tight window when you want to harvest it, but you can't wait too long, otherwise your product spoils. And so that tends to be a bad place to be from a profitability standpoint. And that's the same here with LMNR. Okay, so when I'm talking about ag names, I'm talking about more of the companies that sell to an LMNR, right? Sell the end products, the picks and shovels, shall we say, for the space. So those are the type of businesses that I rather own. There's a reason this has fallen from a high in November around $28, $29 per share, now down to $15. So it's down nearly 50% over the past 7-8 months or so. Don't like that. Negative return on equity, a lot of debt. This would not be a name that I would own. It would actually I would lean on the short side considering they lose money, they have a lot of debt, they're a price taker, etc. You don't want to own LMNR. Thanks for the call.
Stay informed and stay empowered by visiting investtalk.com today.
Now let's talk to Bill from the Bay Area. You want to talk about direct indexing, correct?
Correct.
Okay. What's your question?
Question is, well, first of all, my wife and I are in our 60s, and we've been investing our money for a long time. We self-manage, and recently got together with a certified financial planner who went over our scenario and analyzed our holdings and tax situation and all that. And he recommended that we might consider doing the direct indexing. And I wanted to get your take on how it works, how successful you think it is, and who it's best suited for, what type of investor.
Well, we do direct indexing for our clients, so we know this fairly well, and it is best suited for A, taxable accounts, okay? B, somebody who wants to limit tax liabilities or even potentially take tax losses to offset gains elsewhere. Also, somebody who might want to customize their holdings where you might not want to hold a particular exposure to certain sectors, certain industries, etc., so that, from a kind of values perspective, maybe you don't want to own cigarette stocks or alcohol stocks or whatever. That's always helpful as well. It also, if you are trying to maybe wean off particular over concentration in one company, you can do that kind of systematically and slowly over time. And how it works on our end is we develop it can be custom, it can be whatever you want, but we have some basic setups. My favorite right now is our global custom index, where we're looking at exposure to foreign markets and domestic markets. And what it is you take a sampling of the index. So you might not buy every name in the index. For example, there's the Russell 3000. That's one that we follow. So it's 3,000 names. But we might own 250 names within those 3,000. And those 250 names have similar weightings to different sectors as the overall index. But you might own only 3, 4, 5 names in each sector versus 30 or 40 names. Now, the reason that's helpful is because, the old saying is a rising tide lifts all boats and vice versa. And that depends on the sector, right? When sector performance is 80 to 90% of the performance of any individual name, right? So if the industrial sector is strong, all the industrial stocks are generally going to be strong with, small idiosyncrasies from there. And so when you are direct indexing, you're able to get a sampling and get the names that have the most correlation with those sectors and those weightings, etc. And then, for example, if you have, and maybe this is you, do you have any high concentrations in particular names where you have large capital gains, for example?
Yeah.
Okay. So you can say, okay, I don't want to buy an index because I'm going to also get more of that name. But what I can do is do a direct indexing. I can own I can say, okay, I keep that slice of whatever company that is and not take a lot of gains now. Maybe take a little bit. We can set particular parameters on capital gains. Hey, I only want to take $5,000 for this year, or maybe if I want to harvest losses, etc. And that can limit the amount that is sold from those particular names each year and slowly diversify the names. So you might have say 13% of your portfolio in one company, but the sector itself has maybe 18% of the index. I'm just using random numbers here. And so it's saying, okay, maybe it's in tech. A lot of people have that, right? It might be 13% in tech. It's that one position. Let's trim that down to 12 and then take a sampling of some other names within tech and get that up to your total weighting of the sector of 18%. And then maybe the next year, I trim that back down to 11 and add some more names and create diversity. And so it slowly over time can limit your exposure to capital gains, but still diversify you out of certain names where you might be overexposed to. Does that make sense?
It does. And, as I get older, some of the schemes like this, I understand it, I think, but I'm in a situation where I want to simplify my life. I don't want to it sounds a little bit complicated, and I'm also not sure about.
But that's the thing is you're not doing it, right?
Fees are involved.
But that's the thing is you're not doing it, right?
Fees are involved.
Well, you're not doing it. For us, it's a 1% annual fee. It's charged quarterly, so that's very simple. And we do it, right? So we do it within our systems. It's not something that you have to do. It's just a matter of setting up the parameters. What index do you want to follow? What type of capital gains do you want to make sure you limit to taking each year, et cetera? And once that's done, you don't do anything else. There's no the system does everything. Our back-end software does everything for us. So it's just a matter of setting up the parameters. Are there companies you don't want to own? Are there particular subsectors that you don't want to own? Maybe you do, maybe you don't, et cetera. So once you make those decisions, it's not complicated at all. You don't have to do anything.
Okay. Well, I appreciate your input.
Well, if you ever want to have a conversation about that, I can kind of show you. Obviously, this is just on air, no visuals. We have visuals. There's a website too. If you want to go to our website, there is the custom indexing section over the under investment programs we call it direct indexing. So if you want to check that out, you can head over there. And if you want to schedule a call with me, just click on the portfolio review button. Thanks for the call, Bill.
Great. Thanks.
Let's go talk to Duncan in New York looking at MTPLF. Tell me more. Duncan, you there?
Yep, looking at MetaPlanet. I know it is an over-the-counter stock. The reason why I'm just calling on this was for two things. If you could tell me and the rest of the listeners about over-the-counter stocks. And two, I feel like this is trying to follow the micro strategy. They're just trying to buy a lot of Bitcoin and be a holder of it. And I know this is a company in Japan, but I'm looking to trade this actually rather than really buy and hold. So just wanted to know your 2 cents. Thank you.
Yeah, there are a lot of names that are trying to copy MicroStrategy. Frankly, it's just a levered bet on Bitcoin. If that's the way you want to play it, then that's all you're doing. It's just Bitcoin is obviously very high risk itself. You've seen that over the past decade plus that, it goes through big booms, 200, 300, 400, 500%, rallies, and then falls 70, 80. I believe it's even had a 90% drop over the past decade at some point. So that's the biggest issue with these names is that in a bull market, there's no problem. But when you have a levered position in an asset class that is prone to 70, 80% drops, when those drops come along, they will be wiped out. They will be liquidated, and it'll be worth nothing. Okay? So the question is Bitcoin going to continue to go up? Right now, it's been just kind of hanging around this 100,000 mark. We know it's very tied to liquidity in the marketplace. Liquidity is relatively abundant now, but I've been saying as we enter the back half of this year, which now we're there, right? And you get deeper into the year, liquidity is going to slowly be allocated less towards equities, less towards Bitcoin, and what global balance sheets will be allocated towards is actually refinancing debt. Now, that's mainly on the corporate side, about $850 billion this year, $1 trillion in refinancing next year. These are just simple debt maturities. And then you have, obviously, treasury maturities that are going to have to be refinanced. Now, they're going to continue to issue on the short end. That's a big question. Those are all dynamics that will shape liquidity over the next 18 months or so. So as we get deeper into this year and especially into next year, liquidity dynamics are going to become more challenged. And that means upside to Bitcoin is going to get more challenged, or crypto in general is going to get more challenged. So as a trade, I think in the short term, it's okay because the technicals are fine on Bitcoin, but it's kind of long in the tooth, right? I think we're in the seventh, eighth, maybe ninth inning of this Bitcoin rally. Doesn't mean it can't keep going up to 120, 130, 140 even. If we're in the seventh inning now, probably 130, 140 in that range is probably the peak. But, for a trade, then this would do very well. Same with MicroStrategy. But as I said, it's all about that turn and when that turn happens, and that's always difficult to tell. Now, this is an over-counter name, which means it's more liquid. You can certainly go buy it. There's less regulation around reporting requirements, etc. So, but at the end of the day, this is just a bet on Bitcoin and a leverage bet on Bitcoin. If that's what you're looking for, I don't mind it because I have to look at it, but it probably is cheaper than MicroStrategy because MicroStrategy is trading at egregious valuations compared to its actual Bitcoin holdings. So I probably wouldn't go in that direction either. So if you're looking for a value levered way to play Bitcoin, I guess this would be a name for that.
Awesome. Really appreciate it. Thank you for all that you do.
No problem. Thanks for the call. Now let's touch a bit on, what do I get to? Data centers and the industrial companies that are taking advantage of the current trends in that space. This is an area that is starting to become non-cyclical, and the industrial space tends to be very cyclical. But a lot of these industrial names are chasing the flood of money headed towards AI data center development. I call it the picks and shovels. There's the flashy names like NVIDIA, but there are the industrial names that are helping build and sell specialized products for what we call hyperscalers. Okay, the Amazons, Alphabets, Metas, and Microsofts. They're the main drivers of the investments in AI capacity. Okay, and so these industrial companies are selling backup power generators, cooling pumps, etc., to make sure that these can run 24/7, 365, and produce the requisite power that is needed to do so. Now, U.S. factory activity has declined over the past few months. ISM Manufacturing Purchasing Manager Index, that has been in contractionary territory since March. But spending on data centers continues to go up. About $400 billion will be spent this year to build out the infrastructure during the current fiscal year and expected to grow next year as well. So that's why companies like Honeywell are starting to target these verticals and building out hybrid cooling systems, for example, to make sure that for applications around data centers and similar applications. And this will also produce servicing revenue as well. So it's not just about the current sale, what that adds to the top line today and bottom line today, but it's okay. What about servicing those end products and making sure that their piece of the puzzle continues to run effectively and efficiently? Companies like Generac, they had a boom during the COVID lockdowns, and everyone wanted these generators. That's what Generac does. They sell generators. Well, sales peaked out, we got past the lockdowns and everybody was, a little more calm. You saw sales plummet. Well, they're looking at selling larger generators for these applications. And so even if the economy continues to slow down, this is isolated from economic downturns. And so you want to be looking at, like I said, the picks and shovel companies within this space. There's much better value there. There's much better balance sheets. And in a lot of ways, there's an equal amount of competitive advantages that a company like NVIDIA has, and less companies that are able to do what they do. Okay. NVIDIA has AMD, they have Intel, they have other companies that are nipping at their heels and trying to compete with them on that front. That's the nature of big tech. But when it comes to these industrial companies, it takes a lot of capital to replicate what they do. The history of the expertise that they've built up with cooling, especially, and power generation, that is not as easy to replicate. And as, like I said, very capital intensive. There's a lot of institutional knowledge that they are taking from traditional industrial applications and applying it to these data centers that is allowing them to not only improve the top line in sales, but really improve their overall margin profile, both short term and long term as well. So if you're looking to take advantage of the AI space, make sure you focus just as much on the industrial applications of the data center buildouts as you do the tech names that are inside these data centers as well.
Thank you for watching.
If you liked what you saw, make sure to give us a like and subscribe for more informative content.
My name is Neve. I'm from Boston. I have a question about a company called Perpetua Resources, ticker PPTA. It's a gold miner. I'm interested in adding that to my portfolio. Thank you so much.
Looking at Perpetua Resources, PPTA is a symbol, out of Boise, Idaho, about $1.2 billion market cap. And they have gold and silver deposits, but this is what we call a junior miner. They do not have revenue. They produce losses. And this is a very levered way, similar to a MicroStrategy be a levered bet on Bitcoin. This is kind of a levered bet on gold and silver, but also with the risk that their mines may not eventually produce, and next year they're not supposed to earn money either. Supposed to lose 38 cents this year, 16 cents next year. I don't really, the trends are good because the trends in gold and silver are good. So this is the extreme risk way of betting on the upside of gold and silver. This is a name that bottomed back around March of last year. Well, actually, ultimately, it was all the way back in December of 2022, and that was around $2 per share. Now we're at $12.77. So you can see that type of rally that it can have, and if gold and silver prices continue to go up, I think this will do fine. This will be a target of acquisition from some larger names, etc., depending on how those developments go. But it's very, very high risk. It's not the way we play it. We either own companies that produce profits, that have actual revenue, and that's a safer way to invest in gold. It's still more aggressive and riskier than owning a GLD or the actual physical metal, but it's kind of the good in between. This is, like I said, on the extreme risk spectrum. So that's what you're looking for. I have no problem with it, but it's not the way that we play the gold and silver market. Thanks for the call. Now, lastly, let's talk about tariffs. And tomorrow is supposed to be the deadline, but to really no one's surprise, the deadline is no deadline. It has been pushed to August 1st, so 90 days has turned into 113 days. And then the big question is, will August 1st really be the deadline as well? Now, as Scott Bessent once said, you should take Trump seriously, but not literally. So seriously, because Trump could decide to enforce the deadline, but not literally because he probably won't. This is the taco trade. Okay. And today, President Trump announced deals with Japan and South Korea, which face 25% tariffs as of the first of the month. But the market didn't really react very much. Mainly because the new tariff rate doesn't really increase the effective tax rate at all, because there are carve-outs for things like electronics and pharmaceuticals and automobiles, which for these countries, they're 34% of U.S. imports from those countries each. So the actual effective rate on those countries simply will go from 15.5 to 16.6, a very minor change. That's why the market didn't really react. But now we have a lot of other countries, dozens and dozens, that still need to be agreed upon. Now, there are other quote-unquote deals, but none of them really deals at all. The China one was really more about exports of rare earths, more of a de-escalation. The White House has not released any details about the deal, and China's still withholding exports to U.S. companies, according to the Wall Street Journal. So a lot of this, this is fluff. There's no beef. Where's the beef? There's no beef here, okay? These deals are frameworks at best, and ultimately the question is, will he follow through? And I actually feel there's the Trump put, or the Powell put, or the Fed put, whatever you want to call it. That's if the market goes down a lot, he'll back up. But the market's rallied a lot. And to me, there's also the Trump call, meaning he has now room to actually not be a taco, to actually follow through and be tougher on these trade agreements. And I think that's what the market is underestimating as we head into July and through the summer. Well, that about does it. I'm Justin Klein. This completes another InvestTalk program. And if today's show made you think about your portfolio, your financial path, your financial plan, I encourage you to head over to investtalk.com, click on the portfolio review button, and schedule a no-cost portfolio review with me. Kind of go over your situation and figure out whether there needs to be any changes, that whether it aligns with the current trends in the market, etc. So that's what we do on these calls. We help do a preliminary plan to see if you're on track for all of your different goals. So once again, head over to investtalk.com. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. Be sure to rate and review on iTunes as well. Independent thinking showed success. This is InvestTalk. Good night.